Hello, everyone. I'm Gayatri from Index One, and I'm joined by Chris McHeffey and Cmiel from BX. We're really excited to talk about something that's becoming more and more important in today's market: building smarter index based portfolios that truly align with client risk profiles. Generic allocation models just don't cut it anymore. Advisors need tools that are not only efficient, but also flexible and intentional. That's where high performing, risk adjusted index blends come in. In this session, we'll walk through how these index models can be used to build portfolios that are not only diversified, but also engineered to perform across a range of client types and risk mandates, and how strategies are designed to meet real world needs, whether your client is ultra conservative, growth focused, or somewhere in between. We'll show you how they respond to the challenges advisors are actually facing and how they're built to manage both opportunity and risk with precision. We'll have time for questions after the presentation, so please submit your questions in the chat box as they come up. With that, Craig, could you walk us through some of these strategies and how they've been performing in the current market environment?
Yes, thank you, G. Maybe just one quick intro reference. And the BX works very closely with Index One. Both firms are continually talking to differentiated money managers and research companies, and we collectively take those strategies and reformat them into an index structure. So it's really a strategy, but everything's in an index structure where it's then calculated, back tested, updated daily, positions, holdings, weightings. And collectively, we all just think that's a really elegant, efficient way to build portfolios. So with that said, BX currently works with about 21 different money manager / research companies. Index One represents closer to 40 or 50. So we're in a lot of traffic with firms that produce strategies. So we spend a lot of our time doing manager selection. And is once we get to know a manager before we bring them onto our combined platform, we do a fair amount of due diligence, which includes what you would think of as normal due diligence, but it also includes, what are the number of holdings, and would this fit into an overall model, and does the team have a long track record of generating positive performance in doing what they do best. And so in addition to checking the basic due diligence boxes, we're also then coming in and putting a performance lens on it, in only the strategies that can deliver consistent risk adjusted performance and consistent beating their benchmarks do we then let come onto the BX platform. And so the fourth bullet point down here is of the 65 strategies that are on the BX platform, we want all of them to stand on their own 2 feet. We want them to say, if this was just a standalone strategy, would people want to use it because it effectively does what it's supposed to do, because it effectively outperforms the benchmark, because it effectively takes the right amount of risk to deliver consistency, because at the end of the day, investors and financial advisors want something that they can count on that's consistent. We then take like all the managers that we're trying to put into a model and run them through a correlation framework. So if we're just, as an example, focused on US growth, we'll take all the US growth managers, put them into our correlation analysis engine, and see which ones actually provide the best, offset to risk. And that's where it gets exciting for us, because we're taking a combination of great strategies and great strategists and combining them into a total solution, right? And so that total solution could be like, hey, here's a 3 sleeve growth model that you really get the benefits of the firms doing things differently, but correlating very well. The other thing that we spend a lot of our time on is just risk management. So really the golden rule for us, and this is kind of a Warren Buffett golden rule, which is, rule number one is never lose money, and rule number two is don't forget rule number one. And that's a little cliche, but we really believe that it's important to minimize drawdowns. Two, we think it's really important to alert financial advisors, hey, this is a time where we should be maybe more risk on versus other times where it makes more sense to be a little bit more risk off. Because if you can minimize your drawdowns, take less risk at certain times, we see it time and time again that that's just going to achieve much greater over-cycle performance. And then the last tenet is we just firmly believe that, if you have lots and lots of positions, it's going to be harder and harder to beat a benchmark. So with the S&P 500 as a benchmark, so maybe 15 or 20 of our strategies benchmark against the S&P 500. On average, those strategies have about 30 holdings. If they had 300 holdings, it would be almost impossible to outperform or really underperform the S&P 500. So all of our stuff is all designed to, let's see if we can outperform on a risk-adjusted basis. And so therefore, they have to be active and they have to be concentrated. That's just how we believe that you ultimately get to better performance. So we have a number of different model series, and we'll talk about those in a little bit more in just a second, but we've also created an intro package. So, with 65 strategies, 21 firms that provide those strategies, and really a countless number of models that we can create and have created, it can be a little overwhelming to say, well, I'm just looking for a really good moderate portfolio. I don't need to kind of go into this supermarket. So we've created what we call an intro package, and it's really our 5 kind of building block strategies. One is all equity, one is fixed income, moderate 60-40, moderately conservative, moderately aggressive. The equity is kind of, I referenced earlier, is really 5 very interesting stock strategies that we blend together, and has great historical performance and correlations, and just does a really nice job of putting the different pieces together. The fixed income strategy, everything that we do is through ETF managers, because it's really hard to be trading individual bonds effectively within an SMA or an index. So the 3 managers that we work with that specialize in fixed income are buying the subcomponents of the ag in the form of ETFs, and they put all that together. Then we take combinations of those and put them together. And then really the moderate series of those, right? So you're going to take 40% the fixed income strategy and 60% the equity strategy. When you do that, your benchmark is going to change. But if you're starting off with an equity model that consistently outperforms the equity benchmarks and a fixed income model that consistently outperforms the ag benchmark, when you put that together in a 60-40, you really get something special. It's something that's going to deliver performance, but really take moderate risk at the 60-40 level. So we think that this is a great way for people investors, and particularly financial advisors, say, hey, let me just take a look at these 5 intro models, and put them into integrate them into our tech stack, our trading, and in areas that we keep track of potential models and investments. But we think that these stack up incredibly well compared to all other models that we see in the marketplace. G, I'll turn it back over to you.
Thanks, Craig. Chris, I know Craig talked a bit about the intro package, but what was BX's approach in selecting the core strategy for the intro package? And how do you think about blending them together? And also, where do they fit within a broader portfolio to help drive outperformance?
Yeah, G, I think that's a good question. And it's, part of the beauty of the platform that we've built at BX is that it's hard to come up with a bad answer, right? Because we've selected these 65 strategies from thousands that we've considered over time because we think that they're the best of the best. So part of it is just looking within each of the different types of categories for, what's delivering excellent risk-adjusted performance, and then comparing it to other things that you're thinking about using within the portfolio to deliver that diversification benefit from the low correlation. And so it's an iterative process, and it takes a while, but at the end of the day, we're picking from a growthy category, from a value-y category, from a tactical category, a fixed income category, and a small and mid category, right? So it gives you that diversification, kind of like you would see in most portfolios that you would seek to build. So for this particular series, we landed on these for a couple of reasons that I'll talk about in a minute. We love the Folio Beyond fixed income solution. We have a number of great fixed income solutions, but this one worked great with this package of equity strategies. The Smart Alpha large cap value strategy is a very novel approach to delivering performance in stock with the value factor. The large cap trend capture it's a very specific kind of momentum, and it tends to be very growthy. So now you've got your value-y side, you've got your growthy side. And then the Thor Low Volatility Index is a tactical strategy, and it's in there very specifically to deliver risk management, because it's got the ability to move to more conservative indexes or to cash even when the market dictates that there could be trouble. And then we've got this slice of the small and mid cap momentum, which is driven by another proprietary momentum identification system. And we put them together, and you can turn the slide. Right. So this is the correlation matrix that Craig referred to and that I spoke about. So if you look at the column LCV, that's the large cap value, and you can ignore the correlation to fixed income because obviously that's going to be low, but you'll see that the correlation to the other equity sleeves is 0.6, 0.63, 0.73. And the SDQ, it's 0.6, 0.55, 0.58. Those are remarkably low numbers. Very often we'll put together portfolios that are representative of models that are advertised by large providers. And these numbers are all in the nines, like 0.92, 0.96, 0.88. And really you're getting very little diversification benefit whatsoever from a number of different sleeves that correlate at 0.9. But if you can have equity sleeves correlating at 0.55, 0.58, 0.60, you can have a tremendous diversification benefit, which is going to help result in better risk-adjusted returns. And also I'll point out that, so we've got all these great strategies that we've selected from all around the world, right? And it's taken us years to put together this network of relationships with these providers to have this amazing platform of best-in-class strategies that's really unavailable. None of them are available anywhere else for the most part. And, they've already been due diligence for you. So having that is a really cool kind of accomplishment. But the most gratifying part of what we do is to help build these models, because we build the models and we know, because the sleeves are great. It's great that we've got this great shopping list of strategies that you can use. But at the end of the day, those are just building blocks, right? Not, one of those is not going to be a total client solution. You have to put them together to create a balanced, diversified portfolio for that to be a client solution. So when we build solutions for advisors, we can help them deliver much better results for their clients and make their jobs a lot easier. Because this series of models in particular uses these same strategies just in different proportions depending on how risky the risk profile of the client is. So that makes it very easy for the advisor to understand what's going on and communicate what's going on to their client, because they don't have to follow 50 different things. There's five different strategies at work here. So that's kind of the thought process. How do we make the clients better off and, make the advisor's life easier? So this is just, this is versus the 60-40 benchmark, which is an appropriate benchmark. 60% the Russell 3000, 40% the bond aggregate. So you can see a tremendous amount of outperformance versus that benchmark, and actually really good absolute performance. Like, you wouldn't know there was 40% fixed income in here by looking at those return numbers. But the one that we're the proudest of and that we really, really focus hard on is If you look at that year 2022, I know a lot of you out there are trying to forget the year 2022 ever happened because it was such a nightmare. But look at that, down 1.36% for the year. So what does that mean? It means your clients were at a new high watermark in January of 2023. If you were in that 60-40 benchmark, and chances are if you were in any of the models that are publicly available through the big providers, I'm not going to name any names, you had to wait until December of 23 to be at a new high watermark. So that's a year of your clients being happier had they, been able to leverage this model versus whatever it is in all likelihood that they were using. And that's really what we're seeking to deliver. So this is just a quick look at the 3 different risk levels. So the column labeled instrument is the most aggressive. That's the 80-20. The middle column is the moderate, the 60-40. And the third column is the moderately conservative, which is the 40-60. So you can see exactly what you'd expect, higher returns and higher risk from the most aggressive model. And then medium returns and medium risk for the moderate model and lower returns and lower risk for the more conservative model. And actually and you can see the standard deviation goes from 16 to 13 to 9, which is what you'd expect and hope for. And oddly enough, the Sharpe and Sortino ratios rise to their highest point at the most conservative model because the fixed income has delivered just really, really stellar results versus the bond aggregate. That's why you see, that's a reasonably significant difference in Sharpe and Sortino ratios, but you can see it goes up the scale. Everything moves the way that you'd expect it to move from this kind of blend. So we can deliver these models to you in any one of a number of different ways, or we can work with you and your team to customize something just for you. And you can white label it should you choose to and sell it to your clients as your model. We're happy to work with you on that basis to create whatever it is going to make you and your clients the happiest. So with that, I think that's all I've really got to say about this series, but hopefully I gave a little color behind what we're doing and what we're delivering.
Yeah, Chris, I want to talk a little bit about some of the other model categories that we've designed, because today we're really just zeroing in on sort of this, for lack of a better word, let's call it 60-40, right? And what's really fascinating is if an investor started the year January 1st, so today's July 24th, 2025 at 11 in the morning, East Coast time. But if you had invested your dollar into the 60-40 on January 1st of this year and put 40% of your money in the AGG and 60% of your money in the SPY, your AGG would have performed, so year to date, it's up 1.25%. The SPY year to date is up 8%. And so if you mush those two together in a 60-40, you'd be up something like 5.5% this year. Now the AGG has really kind of been flat all year, give or take a percentage point up or down. But what's fascinating about the SPY is from January 1st to April 8th, it was down roughly 14%. And from April 8th to today, it's up roughly 27%. And so if you just started the year and just had those two ETFs and looked at it today, you'd be up 5.5%. You'd be taking a lot of risk associated with that movement in the equity market. But also, you would have also missed the opportunity to be more active at periods of time where the risk signals were kicking off. So we think that that's a great benchmark to compete against because by sprinkling in some risk management, a little bit more activity, the proper rebalancing and reconstitution of a portfolio, that investors can make several percentage points more return with a little less volatility. As we talked about today, we're really kind of zeroing in on some of the risk-based models, the 60-40s. We've also created a suite that's simply called the Alpha Mandate. So sometimes we're approached to say, can you guys just help me create a sleeve or sleeves that are designed to create alpha? Our oldest model is one that we call the 10-10-10, which is a sleeve of 10 dividend growers, a sleeve of 10 US momentum, and a sleeve of 10 international momentum. 30 total stocks. You can mix and match it however you want. But it's a perfect example of like active and concentration, but you still got total diversification within your 30 holdings. And that blend is historically and in real time delivering really nice outperformance. We have some new risk hedge products that are designed, models that are designed that when some of the research that we use as being more defensive, it's going to shift from growthier to value and cash. And so we think that those are really nice risk management tools to have in a portfolio. We also have a tactical suite of models, which is really taking our 10 or 11 different tactical strategies that are run by different people, and we blend them together in the most optimal way. So we get really great outperformance, mostly by managing drawdowns. We have sector and industry suites. We have all kinds of models that we built against both the nitrogen and stratify scoring systems. So if you're a financial advisor and you rank your clients 1 to 100 or 1 to 10, we've fine-tuned and optimized ideal client risk portfolios. We have a new income model, a new growth and income model to go along with the fixed income model that Chris was just talking about. So at the end of the day, we think clients want cash flow. Once they get to a certain age, they want to actually pull money back out of their investments. So we've designed some strategies so that they can take out 5% plus per year in cash flow, but also compete against inflation and also keep up with rising stock prices. So we have a lot more information on that. We're happy to send it out to anybody. And G, I'll turn it back over to you.
Thanks, Craig, and thanks, Chris, for that. Cool. So all I really have to say is Index One's really proud to serve as the index calculation provider for the BX strategies that we featured today. It's especially exciting to see these strategies thoughtfully blended into portfolios and are aimed at driving outperformance while aligning with clients' risk profiles and their broader investment goals. All the BX models discussed in today's session are available on both the BX and Index One websites. If you have a strategy you'd like to calculate in real time as an index and potentially integrate it into other portfolios, please feel free to reach out to us. We're now moving into the Q&A portion of the webinar. Please feel free to submit your questions in the chat box and we'll address them as they come in. And we actually have a question from Rakesh. What do you offer for self-directed or family office? Right, Chris?
So I would answer that really simply. What we'd want to do is explore what the particular goals and needs of that family office are. But we do have this platform filled with world-class investment strategies that are really appropriate for any kind of pools of money. But specifically, if this is a hugely tax-conscious situation, we've recently created some portfolios where ordinarily we believe in concentration to deliver return, but we're aware that, some, for example, family offices, very high net worth investors are extremely tax sensitive and want to be able to tax loss harvest their portfolios on an ongoing basis. So we've created blends, basically models that are all equity, because the fixed income that we have is all taxable. So I'm assuming that the bonds are going to get done elsewhere. They have about 350 holdings, so it's ideally suited to be tax loss harvested on a running basis, where the portfolio is delivered about 300 basis points of excess return versus the appropriate benchmark. So you wind up in a situation where it should make a family office very, very happy to have 300 basis points of investment alpha plus whatever tax alpha they're going to be able to generate by doing tax loss harvesting on an ongoing basis. Now, for the qualified wings, for the endowments or whatever, for qualified money, you can use our very active strategies, and many family offices have shown very high interest in some of them for that. But some of the strategies are not hugely tax aware. We'd have to get a feel for what you're trying to do with what kind of pools of money to best answer that question. But I think that addresses it as best as I can for the broad audience.
Yeah, I would just add to that. We do a fair amount of currency work today for our family office institutional clients. We can actually use multiple currencies, which I think is helpful. The other thing we can do that's not part of the liquid platform is we do have hedge funds, long, short, managed futures, things like that can also be part of a conversation with an institution like a family office.
Thanks both. And as far as Index One's concerned, if you have a strategy that you'd like back tested and calculated in real time, we're definitely the point of contact. So please feel free to reach out to any one of us to discuss your needs further. Thank you, Rakesh, for your question. Amazing. One other question, or maybe two, is how would you say advisors can really build scalable models that are customized for their clients? I know you touched upon it a bit, but is there anything else that you'd like to add to answer that question?
What we see is that whether you're an individual advisor or a group of advisors, that typically you're as Chris went through today, you're going to have 4 or 5 or 6 sort of home bases, right? Where it's going to be, all right, this is our house view on what a moderate, conservative growth would look like. So that's really step one in creating scale. The customization comes in when you're talking to a client. Do you want to put a sleeve of something else in there? Do you want to put a sleeve of tactical, or do you want more income? Do you want more exposure to international? And so with all the pieces in place, you can, in real time, you build a custom solution, but do it in a very elegant and scalable way. And we bundle all that up in a really nice proposal tool, so that an advisor, while they're talking to a client or just before a meeting, can say, okay, this is what I want this client's proposal to look like, and they'll be able to show them all the reasons why that makes a lot of sense.
Thanks, Craig. And this is probably a really generic question, but what factors do you consider when creating an outperforming strategy?
Chris, I'll let you take that one.
Yeah, G, I mean, I kind of think we touched on this, but we employ a really rigorous due diligence process in order to create, what's going to be included in our platform. So we have pretty high confidence that anything on our shopping list, so to speak, is going to deliver over the cycle outperformance on a risk-adjusted basis. That's why it's there. And then, but like I said up at the beginning, we like to choose from different categories and put them together to create comprehensive portfolio solutions, just like just about anybody that would build a portfolio looks to do. And then, like I said, I'd like to see how the sleeves interact with each other, by looking at things like the correlation matrix and playing around a little bit with what's the ideal kind of rebalancing cycle and, certain things of that nature. But at the end of the day, if you're starting with really good ingredients, you're probably going to make a pretty good product. But, you can take these building blocks and build, a pretty good structure, or you can build a great structure. It just takes a lot more work to do the second.
Awesome. Thanks, Chris. And thank you everyone for your time and participation. Be sure to subscribe to our email newsletters to stay updated on our next video content. In the meantime, thank you all for tuning in, and we look forward to seeing you next time. Thanks, everyone.
Thanks, G. Bye, all.
Thank you.